Hello everyone. So in this video I'm going to give you a basic conceptual understanding of what it is that we mean by financial cash flow. So we're going to talk about what is financial cash flow, and equally importantly we're going to talk about what isn't financial cash flow. So put very simply, financial cash flow of an investment is nothing but the cash flow that we're expecting from the project's assets. Right? So whatever is the cash flow that we're expecting from the assets that we are investing in as part of a project, that basically is financial cash flow. Let me try and explain. Let's suppose that you decide to invest in a restaurant. So the project that you are considering is investing in a restaurant. Okay. Now, in the beginning, this will require a significant amount of investment. Specifically, it will require investment in, say, property. So you may have to buy a building. And then in addition to the property, you may have to buy some equipment. So all your ovens, your refrigerators, your freezers, etc. And then after that, you may also have to, invest some money in fixtures. So these will be all the paintings, the tables, the chairs, the booths, all of that. So there's all this investment that you will be making in these different types of assets. But notice that the assets that I have listed over here, these are more fixed assets or long-term assets because they get used over a long period of time or more than 1 year. Now, in contrast, there will be some other types of assets. For example, inventory. Inventory is something like your tomatoes and potatoes and all of that. And this is again an investment, but more in a short-term asset, right? Because you invest something like $100,000 in inventory. It's an investment because it's going to help you generate some sales later on. But the main point is that your investment will be in two types of assets related to this restaurant: long-term assets and short-term assets. Now, what this investment in these assets is going to help you do is that it is going to help you operate the assets. In other words, now you are in a position to tell your chefs, hey, go. You have the property, you have the equipment, you have all the fixtures, you have the inventory, start making some dishes. We're going to start generating some sales. So now all of a sudden you're going to have some operations. Now this will entail you making some sales, but then of course there will be some, call them operating costs. These are costs related to your operations. For example, you're going to be paying wages, you're going to be paying some utility bills and all of that. My main point is this. When we say what is the financial cash flow that we are generating from an investment, what we're really saying is that, look, there are two sides to it. On the one hand, assets are going to be eating our money because this money will go into buying property, equipment, fixtures, inventory, and all that. But then all that investment eventually is going to help our operations, and this is where the money is going to come from. And so if we think about financial cash flow, it is nothing but the difference between the cash flow that we are generating from operating the assets net of any cash flow that we're spending investing in those very assets. This, in the most broadest of ways, is how we can define financial cash flows. It is nothing but the cash flows from the project's assets, which basically has two components to it: the inflows, which are coming from operations, and the outflows, which are happening in terms of investments. Now, more often than not, the way financial cash flow equation is expressed is as follows. It is represented as operating cash flow minus CAPEX, which is short for capital expenditures, and then minus change, this is very important, change in net working capital, where, as you may recall, net working capital is the difference between current assets and current liabilities. Now, there are other variations of this expression as well, and I'm not going to go into the details of that at this stage, and neither am I going to go into the details of how we measure each of these components. Again, the idea here is to just give you a conceptual understanding of what financial cash flow is. And now if you look at this equation and this equation, basically they're saying the exact same thing. We're saying, look, our assets are going to generate some cash flow for us through operations. So that's what we call operating cash flows. However, our assets are also going to be eating up money because we need to invest in those assets. There are two types of investments. One is in long-term assets, as we just saw. That is being represented by CAPEX. This is capital expenditure. So this is investment in long-term assets. And the other investment is in short-term assets like inventory, and that is getting reflected by investments in net working capital. So the way you want to interpret change in net working capital is that this is sort of like investment in short-term assets. Right? So for example, let's suppose that you're running the restaurant and all of a sudden you say, you know what, I think I need to increase, for some reason, I need to increase the inventory by $50,000 because maybe, people are going to get their Christmas bonuses and they're going to be eating a lot. So I want to invest more in inventory so that I can sell more. Well, immediately the impact of this high inventory is going to be that it is going to increase your current assets, right? Because inventory is a current asset, which means current assets minus current liabilities, which is net working capital. This is going to go up, which means that your net working capital going up means the change in net working capital is positive. So net working capital is going up by $50,000. And that is an alternative way of saying, therefore, that our financial cash flow is going down or decreasing by $50,000, which is exactly what's happening. More of our money is getting tied up in inventory and therefore in the short-term assets. And this is our way of acknowledging a short-term investment in assets as well. Please bear one important thing in mind. Financial cash flow is not always a positive number. I know that when we say, oh, financial cash flow is cash flow from a project's assets, the word from seems to misleadingly suggest that we are always getting money from the project's assets. That's not true. Financial cash flow can be positive. It can be negative as well. Of course, it's going to be negative when the money that you're generating from operations is not high enough to compensate for the money that we're spending on long-term assets and changes in net working capital. More specifically, at an early stage of an investment's life, like if you're spending money on a restaurant, at an early stage when the restaurant is not even operational, at that stage, operating cash flow is practically going to be zero, but you're going to have a high amount that you're spending on CAPEX and changes in net working capital. So in that sort of a situation, your cash flow will be a negative number, or your financial cash flow will be a negative number. So that's one thing to bear in mind. The other thing to bear in mind is that capital expenditure and changes in net working capital are not things that just happen at the initial stage of an investment's life. Sometimes these are recurring expenditures. So even in year 4, year 5, let's suppose your restaurant is perfectly operational. You are generating some money over here. It is entirely possible that even in years 4, 5, or 10, you're continuing to make more capital expenditures, investing more money in changes in net working capital. Let's suppose you're growing, you're going from one restaurant to the second to the third. Then you're generating money from operations, but you're also continuing to expand. So don't let this expression fool you into believing that CAPEX and change in net working capital is just something that is happening at an early stage. Financial cash flow at any point in time. So maybe it will be better if I write this. Operating financial cash flow at any time period T is measured as operating cash flow at time period T minus the capital expenditure at that time period T minus any changes in net working capital at that time. And it all really depends on the magnitude of these three numbers at that particular point in time. Now that we've talked about what is financial cash flow, I want to very quickly give you a rundown on two things to bear in mind with respect to what isn't financial cash flow. So look, financial cash flow is, as we've just said, is how much you're generating from operating the assets net of how much you're spending or investing in those assets. Please understand this. First, profit and financial cash flow are two very different things. Just because you have profitable operations does not mean that you are generating a high amount of financial cash flows. Profitability has got more to do with operations. right? So if you're making a lot of sales and if your costs are low, you will have high profits. But that does not necessarily mean that your financial cash flows are high, because financial cash flows not only look at what you're doing on the operation side, they're also looking at where the money is going in terms of long-term investments and short-term investments. So one classic example of this is Netflix. If you take a look at Netflix's profitability, over time, Netflix's profitability has been rising. By the end of 2017, they had about $560 million worth of profits. And at the end of 2018, in fact, they reported profits close to 800 million. So profitability is clearly on the rise, and you could say, okay, maybe they have profitable operations. That's all fine. But if you actually go ahead and calculate the financial cash flows for Netflix, financial cash flows have been on the decline for the most part for Netflix. And why is that? Because Netflix has had to spend a lot of money on content. That's why people continue to subscribe to Netflix, because they're always looking for more and more content, which is why financial cash flow for Netflix is negative, because they're having to spend a lot of money on content at all times. So even though they are high over here, they're also high on this part, and this part, the CAPEX part, sort of dominates what they're doing on the operating side, which means that their financial cash flow is continually negative. So that is one of the concerns investors have with Netflix. Look, what is the deal with your negative financial cash flow, man? Because look, if you are somebody who's lent money to Netflix, whether as an equity holder or a bank, you don't care about high profitability. You care about the cash flow, right? Because you gave Netflix your money, and what you're asking in return is, show me the money, baby. Where's the money? And financial cash flow is basically the money, which unfortunately at Netflix is negative right now. So that's one important thing to bear in mind, that financial cash flow and profit are two very different things. The other important thing that you want to bear in mind is this. Profit is not even the same thing as operating cash flow. In other words, if you're looking at an investment and you're trying to understand, look, how much profit am I making from these operations that I'm running? What I'm saying to you is that the profit that you're making from those operations could be a different number from the cash flow that you are generating from the same operations. The reason why that happens primarily is because of the presence of non-cash expenses like depreciation on the income statement. So let's suppose that in a given year, you maybe generate cash sales of $100,000. And let's suppose you have cost of goods sold of $60,000. So this is the money that you actually paid out in cash for your purchases and utilities and expenses and all that. One other expense that you will have on your income statement is depreciation, which is a non-cash expense of $10,000. When we say that this is a non-cash expense, what that really means is that this $10,000 never actually left your pocket. The reason why it exists on an income statement is because of this matching principle in accounting, which basically says that if you're using a portion of your long-term asset in this specific year, then you should match the use of that asset and how much it's costing you in that year on the income statement right about here, which means that basically you're saying that, hey, that van that I bought like 3 years ago, I'm basically using $10,000 worth of that van in this particular year. But that doesn't mean that this $10,000 actually left your pocket this year. All the money that you spent on that van, that happened when you purchased the van 3 years ago. My point is this. When you will report profit or operating profit, which is also known as earnings before interest and taxes, you will show $30,000, which is $100,000 minus 60 minus 10. But this $10,000 never actually left your pocket, which means that your operating profit is $30,000, but your operating cash flow is actually higher, because this $10,000 never actually left your pocket. And so the main reason why I am emphasizing all of this is because whenever we are evaluating investments, we never, ever, ever should focus just on profitability. Profitability neither gives you an understanding of what the financial cash flow is, but it also seldom even represents your operating cash flow, which is only portion of the financial cash flow equation that you should look at. So in subsequent videos, I'm going to give you a little bit more insight into this financial cash flow equation. What I mean by that is that we're going to try and understand, how can we measure operating cash flow specifically? We've seen that it's different from operating profits. So the question is, how can we measure operating cash flow for different types of investments? What are the different things that we should be wary of when we're trying to measure capital expenditure? And also, why do we have this term change over here? And what are the different things that we need to be cognizant of when we're trying to measure change in net working capital for different types of investments? So all of that follows later, but the main concept will remain the same. Ultimately, number one, we care about financial cash flows and never profits. And secondly, financial cash flow is nothing but the difference between what we are generating in cash from operations net of the cash that we're spending making both long-term and short-term investments.